Welcome. The modeling explored in these videos places the volatility effect and other issues in a new light. The persistent high alphas for low CAPM beta portfolios over time are likely a statistical artifact of ordinary least squares regression rather than a true economic anomaly, while the high Sharpe ratios of low CAPM beta portfolios are likely to be an ongoing phenomenon. Like the capital asset pricing model, the perturbation risk model has two components, risk and return. Return has two components, ideal return and perturbation return. Risk has two components, ideal risk and perturbation risk. Ideal returns are pure economic fair value returns. Perturbation returns are not accounted for by changes in fair value. They are expected to be zero and are mean reverting. They are analogous to or the same as excess volatility. In the modeling of these videos, the volatility effect occurs as a result of the distribution of perturbation risk and how the distribution coincides or differs from the distribution of ideal risk. That is, the volatility effect is the result of the magnitude and distribution of the perturbation risk among securities. The definition of the volatility effect for this series of videos was given as, given these two expectations, the volatility effect is the consistency of these two realizations in a generally rising market. In video 9 it was stated, to the extent that 9.6 and 9.7 can be expressed as mathematical expectations ex ante, the volatility effect is resolved. In the perturbation risk model, inequality 9.6 has been shown to be a mathematical expectation, and inequality 9.7 has been shown to be a practical expectation, or possibly a mathematical expectation depending on how conditions are interpreted. 9.6 and 9.7 are realized because full condition 9 in line 21.9 is met, and so both parts of scenario 9 are expected. Separating out ideal risk from perturbation risk gives many new formulas, techniques, and insights. It also gives many new problems to investigate. Perturbation risk itself has two components, that which contributes to market risk or traditional systematic risk, and that which sums to zero across all securities in each time period called perturbation alpha. Although the component perturbation alphas do not have a zero expected value when conditioned on a non-zero perturbation. The components of CAPM are alpha, beta, market return, market variance, idiosyncratic risk, and their combinations. The components of PRM are perturbation alpha, ideal beta, ideal market return, ideal market variance, perturbation market return, perturbation market variance, and their combinations. There is no simple correspondence between the components of CAPM and the components of PRM. CAPM beta now has three equivalent formulas. Also, with respect to the original problem formulation, CAPM beta for the low CAPM beta portfolio has this formula. Here are the 5 possible combinations of perturbation attributes. Combination 2 is note 6 in video 22. Combination 3 has a non-zero alpha but no idiosyncratic risk. Combination 5 is the real world. There are many places in the videos where lesser problems were left unresolved, details were skipped, or some problems were even completely unmentioned. For instance, in video 9, the structure of correlation and beta deciles is almost surely correct, but a proof was not pursued. An analysis of this and related issues can be found in videos 30 and 31. Sometimes the algebraic development of an equation was left out because it seemed to be a distraction from more important points. One unmentioned aspect is the fact that although the low CAPM beta is lower than the high CAPM beta, it is not necessarily the case that the low ideal beta associated with the low CAPM beta portfolio is lower than the high ideal beta associated with the high CAPM beta portfolio. The order can be reversed. Here are some additional areas in need of further development. At a practical level, what are the implications of the perturbation risk model for short selling, diversification, and short-term versus long-term investment strategies? Different investment strategies result from having different investment time frames. Different time frames may well put investors at odds with each other, with some investors seeking negative H and others seeking positive H. A long-term investor would seek to minimize H in order to maximize geometric return. A single time frame investor might seek a high H if high market returns are anticipated, or seek a low H if negative market returns are anticipated, or perhaps use short selling or exit the market if investment policy allows such a response when low returns are anticipated. The existence of high H investors could create a self-fulfilling result as each investor tries to beat the other investors into or out of the door. This could influence institutional pressure on managers of mutual funds who seek impressive short-term results. So this is one area in need of further development. Here are some additional areas also in need of development. The backward perturbation risk model for an individual stock is lacking. The estimation method for ideal beta needs to be improved. The causes of the magnitude of the perturbations should be developed. The methods to estimate the magnitude of excess volatility needs improvement. What are the implications of the perturbation risk model for metrics such as tracking error? It's clear in the perturbation risk model that the market portfolio is not on the efficient frontier. What does the capital market line look like in the perturbation risk model, and what does it mean for efficient market theory? Is the equality of Sharpe ratios the best meaning of market efficiency in the PRM? The zero beta portfolio should be re-examined because current methods likely have some residual ideal systematic risk. What are the implications for PRM if the variables of ideal return and perturbation return are non-normal, perhaps log-normal? Returns would then be the sum of two log-normal random variables, perhaps correlated log-normal random variables. The mathematics is no longer so straightforward, but perhaps more realistic. What are the broader implications for OLS if the independent variable is the sum of two random variables that cannot be easily separated, such as signal plus accumulated noise? Many things have been left unexplored. I have not intended to answer every question, but only lay out the main arguments. I think I'll stop here.